I take questions. One glaring weakness, or absence, I should say, in this view that capital income tax should be broad-based and at a similar rate to labor income tax in New Zealand is the capital gains tax. And in case you aren't familiar with it, it's a tax on capital gains, which some countries have. But I gather has never existed here. A lot of problems, and I'll come back to this in a moment, in terms of the internal consistency of the tax system arise from the absence of the capital gains tax. And there are reasons, good reasons, for shying away from introducing a capital gains tax that the Tax Working Group report discusses. Nevertheless, there are problems in not having one, and they come up in particular when discussing the issues of corporate taxation, which I will now talk about. There are several issues that one can think of when analyzing corporate taxation. Two that I'll talk about here that come up in the Tax Working Group report are one more than the other are alignment, the alignment of individual and corporate rates, and the tax treatment of foreign source income. Now, on the alignment question, there's a lot in the Tax Working Group report. That is, if you were looking at the different reports and thinking, well, what are the important issues of tax policy? The alignment question gets a lot of attention in the Tax Working Group report, more so than in either the Mirrlees review or in the Henry report. And it gets some in the Henry report, really none in the Mirrlees review. One of the reasons it doesn't get any attention in the Mirrlees review is because their proposed changes in the tax treatment of capital income make it less of an issue. It's not really as important anymore with the changes that they suggest. So it's natural that they wouldn't consider that as an issue. But it is an obvious issue in the view of the Tax Working Group. What is the problem of having a lack of alignment? That is, what is the problem, for example, of having a corporate rate which is much lower than the top individual tax rate? Well, the problem is that you can accumulate earnings within a corporation. If those earnings are not paid out, they're subject only to the corporate tax, which is lower than the individual tax. And so that gives a strong incentive for using corporations for accumulation. Now, one of the reasons why this is a problem from the point of view of New Zealand in the eyes of the Tax Working Group is that it also, having a high corporate tax rate may make the country less competitive with respect, for example, to Australia, which with a lower tax rate would put a lot of competitive pressure on New Zealand, a lower tax rate, for example, that was recommended by the Henry Review. So the Tax Working Group report notes the tension. On the one hand, perhaps seeing reasons why you would want to have a lower corporate tax rate for purposes of international competition, but on the other hand, for purposes of the coherence of the internal coherence of the tax system and alignment between the corporate and the individual rate, wanting to keep the corporate rate relatively high, close to the individual tax rate. This wouldn't be as big an issue if there were a capital gains tax rate, because the ability to avoid individual tax that would raise the tax burden to a more closer to the individual level on accumulated earnings would not be as great if those accumulations were at some point subject to additional tax in the form of capital gains tax. And that would be another reason why it's more of an issue in New Zealand than it would be in other countries. And I think this is an illustration. The Tax Working Group certainly noted the absence of a capital gains tax and the problems that were associated with it, but this attention to what is feasible and leaving the capital gains out of at least of the category of feasibility does alter the nature of the analysis. And I think it's worth keeping that in mind. That is, perhaps there would have been less attention to alignment and more attention to other issues if a capital gains tax were in place or could be put in place. Now, on the international side, there's actually relatively little in the Tax Working Group report. There is some discussion of modification of thin capitalization rules to lessen the ability of companies to shift earnings out of New Zealand to lower tax jurisdictions. But there isn't that much more. In contrast, especially to the Mirrlees review, which has a long discussion, a chapter devoted to the treatment of foreign source income. This is a big issue in tax policy. It's a big issue in tax policy for all countries, and I think there's a lot to be said about it, and a lot of thinking that exists. Countries have been moving toward a territorial tax system, that is an exemption of active foreign source income, something New Zealand did recently, something that the UK has done recently, Japan has done recently. The US is the last major holdout, but there's a lot of pressure in the US to do it too, all for reasons of international tax competition. It's hard for to attract companies to locate in your country, that is to be resident in your country, if you're taxing their income from abroad when other host countries are not. And that's one of the things that has led to the adoption of territorial taxes. But territorial tax systems have their own problems, which are discussed in some detail in the Mirrlees review, but not in the other reviews, and could, if there were enough hours in the day, have been discussed in the other reports, I think. That with the territorial tax system, are stronger incentives to shift profits and expenses around to different, among different jurisdictions in which a company operates, to try to maximize the value of deductions and minimize the tax on revenues. And I believe there are better ways. I've suggested some in my own work, which might involve taxing based on destination rather than either on source, which is what territorial systems do, or on residence, which is what the U.S. system is trying to do. These are ideas that are just being developed these days. We're not really at the point of implementing these in a new tax system, but I was happy that the Mirrlees review did consider this material, and I think in the years to come, as tax competition among countries continues to be very, very strong, I think we will be searching for improved ways of taxing foreign source income. Now, I'll go just a couple of brief comments about other parts of the tax system and other things analyzed by the tax working group. One of the things that isn't is wealth transfer taxes. It's not analyzed in the Henry review either. It is discussed in the Mirrlees review, and these differences align exactly with the existence or lack of existence of wealth transfer taxes in the different countries. Now, you can logically separate the issue of wealth transfer taxes from, say, a broad-based income tax. They really are different taxes. But in particular, one of the things that's been changing in the world is the income distribution. Here's a picture from the Mirrlees review, a table from the Mirrlees review, showing the ratio of wages of male earners in the 90th percentile, that is the top 10% of the wage distribution, and the 10th percentile, the bottom 10% of the wage distribution, for a variety of countries between 1980 and 2000. So the higher the ratio, the more inequality there is in a country. And as you look down the table and across, you'll see numbers rising from left to right as inequality has increased around the world. But it's increased around the world at different rates. New Zealand started not exactly in the middle, a little bit on the high end, but not the highest, and it's increased. If you compare it to Australia, you see Australia started out pretty much in the same place, but hasn't, at least through 2000, had less of an increase in inequality. What's happened in New Zealand is more similar to what's happened in the United Kingdom. The U.S. there at the bottom is off the charts, as it were, in terms of the degree of inequality that we have, both at the beginning of the period, but especially at the end of the period. And this is a great concern in the United States. It really does color the discussion of tax policy and has led in the U.S. to a lot of focus on the income taxes on higher income individuals, but also on the estate tax, which we have. And if this is to be an issue of continuing importance in New Zealand as well as in other countries, I think it does make a consideration of wealth transfer taxes perhaps more relevant. Taxing economic rents. The tax working group entertains the idea of imposing a small tax on land rent. Going back to the writer Henry George, late in the 19th century, this was viewed as an ideal tax. It's a non-distortionary tax, and it's also relatively progressive if we think of land ownership as occurring more in the upper part of the income distribution. The Mirrlees review, in its own way, and the way it discussed taxing capital income, was really talking about focusing more on taxing rents rather than taxing normal returns to capital. This is, in one sense, an obvious economic prescription to find things where decisions aren't really affected by the tax and trying to apply a tax to it. But getting back to the issue of fairness, this is also something that many taxpayers and viewers might find disturbing, that you would find a particular activity that is not very changeable and then tax that activity simply because the individual can't do anything about the tax that you've imposed. That is one of the reasons why taxing land rents, although it was proposed by Henry George over 100 years ago, hasn't really made a lot of progress around the world. And it really relates to the enormous fight that happened in Australia in 2010 over the proposed change in the taxation of natural resource earnings. Because what was being proposed by the Henry Review was a tax on economic rent. That is, they were they came up with a system of taxing the earnings of natural resource companies that would have less of an impact on economic decisions than the existing system of royalties. So in an academic sense, it was a better tax design. But it was also a tax that would have been very difficult for the taxpayers to shift to others in the economy. And those taxpayers probably didn't get that excited about the fact that it would be a more efficient tax. What occurred to them was it would be a tax that was more likely to stay with them. And, of course, that makes taxpayers unhappy, because it's not surprising that taxpayers are not infused with so much altruism that they want to help fund the government when it isn't absolutely necessary. Low-income benefits. Here's an area where all of the reviews agree that it makes sense to rationalize the benefits that low-income individuals receive. This is a really good example where the lack of coherence and the lack of consistency can be found. Tax systems. The U.S., at one time before reform it had a few years ago, had, I think, some large number of definitions of a child in the tax code according to different provisions. And you could have very, very haphazard coverage of the provisions because they were each put in independently. This is a picture of the effective marginal tax rates under the current tax and transfer system in New Zealand. And these jumps and drops in the marginal tax rates are associated with different provisions phasing in and phasing out independently. You wouldn't design a tax system this way, but each individual provision on its own may have looked reasonable. And so I think this is a really good illustration of the benefits of tax reform and of trying to step back and look at all the provisions at once and think how they might be rationalized. There was a lot in the Mirrlees review about this in terms of adjusting child benefits with respect to the age of the child. And I think this is a very productive approach. Environmental taxation is something that was not considered at all in the tax review. It was outside of its scope of analysis. It wasn't really considered in the Henry Review either. By contrast, the Mirrlees Review devoted 3 chapters to it, which is more than any other subject. And part of that may reflect the fact that New Zealand's made more progress in adopting environmental taxes than other countries have, and so needs to devote less attention to it. Part of it may also be that the Mirrlees Review is taking a somewhat broader perspective of what taxes it wanted to consider. But I certainly think that, given what's happening in the world, environmental taxation will be an area in which we will want to be doing a lot more thinking in terms of tax policy. Now, again, you might say one adopts environmental taxes for different purposes than one would adopt income taxes. That is, they're not simply there for raising revenue, but there is an interaction between environmental taxes and other taxes. And so as you're thinking about the right tax structure, if possible, it would be better to think about environmental taxes as well. In countries like the U.S., it would be especially valuable because we rely far less on market-type mechanisms for controlling emissions and other externalities, and much more on regulations and other older-style provisions which have I think, are much more have much higher economic costs in terms of the benefits that they provide.